Welcome to Smart Stock Watch, your go-to channel for in-depth financial analysis. Today is June 3rd, 2025, and we're diving into the first quarter fiscal 2026 earnings report of Signet Jewelers, the world's largest retailer of diamond jewelry. Joining us is John, senior analyst from Smart Stock Watch. John, thanks for being here.
Thank you for having me. It's a pleasure to discuss Signet Jewelers' latest performance, especially given their position in the market and the strategic initiatives they've been implementing.
Revenue and profitability overview. Let's start with the top line. Signet Jewelers reported sales of $1.5 billion for the first quarter of fiscal 2026, which is a 2% increase compared to the same period last year. John, can you elaborate on the factors driving this growth?
Absolutely. The growth in sales is primarily driven by a 2 and 5% increase in same-store sales, which includes both physical stores and e-commerce. This indicates a strong consumer demand across their platforms. Additionally, their adjusted operating income saw a significant rise to $70.3 million from $57.8 million in the previous year, showcasing improved operational efficiencies.
And what about their earnings per share?
Signet's adjusted diluted EPS came in at $1.18, up from $1.11 in the first quarter of fiscal 2025. This improvement is attributed to higher adjusted operating income and a lower diluted share count, despite a higher effective tax rate.
Strategic initiatives and brand performance. Signet has been focusing on its Grow Brand Love strategy. How is this impacting their performance, particularly for their key brands?
The Grow Brand Love strategy is indeed gaining traction. Signet CEO J.K. Symancyk highlighted that their three largest brands, Kay, Zales, and Jared, saw sequential comp sales improvement with higher margins. This strategy is driving growth in both bridal and fashion segments, which is crucial for their market positioning.
And how has this strategy affected their merchandise pricing?
They've seen an approximate 8% increase in merchandise average unit retail, which suggests that their refined promotional strategy and inventory management are effectively enhancing their gross merchandise margin.
Financial guidance and shareholder returns. Looking ahead, what guidance has Signet provided for fiscal 2026, and how are they planning to return value to shareholders?
Signet has updated its fiscal 2026 guidance, projecting total sales between $6.57 billion and $6.80 billion. They've also raised their adjusted EPS guidance to a range of $7.70 to $9.38. In terms of shareholder returns, they've repurchased approximately 2.1 million shares and declared a quarterly cash dividend of 32 cents per share.
That's quite a commitment to shareholder value. How does this align with their overall financial strategy?
It aligns well with their strategy to enhance shareholder value through disciplined capital allocation. The share repurchases and dividends reflect their confidence in the business's cash flow generation and future prospects.
Operational efficiencies and future outlook. John, let's talk about operational efficiencies. How has Signet managed its costs and margins this quarter?
Signet has done a commendable job in expanding its gross margin by 100 basis points to 38.8%, driven by gross merchandise margin expansion and leverage on fixed costs. Their SG&A expenses were $526 million, which is 34.1% of sales, showing effective cost management.
And what about their inventory levels?
Inventory ended the quarter at $2.0 billion, up approximately 1% from the previous year. This slight increase is well managed, considering the sales growth, and indicates a balanced approach to inventory management.
What can we expect from Signet moving forward?
With their strategic initiatives and strong brand performance, Signet is well positioned for continued growth. Their focus on operational efficiencies and shareholder returns should support a positive outlook for the rest of the fiscal year.
Key takeaways. In summary, Signet Jewelers has delivered a strong first quarter with notable sales growth and improved profitability. Their strategic focus and commitment to shareholder returns are evident in their performance. John, any final thoughts?
Signet's ability to exceed EPS expectations and their proactive approach to capital allocation are impressive. Investors should keep an eye on their strategic initiatives and market conditions as they continue to execute their growth plans.
Thank you, John, for your insights, and thank you to our viewers for tuning in. If you found this analysis helpful, please like, share, and subscribe to Smart Stock Watch. We'd love to hear your thoughts on Signet's performance in the comments below. Until next time.